Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So it's a really interesting market because it is so good at reflecting forces that are at play in other markets. And I think that this makes it particularly productive when we talk about selling options. Now what I'd like to do is present a couple of ideas. And these aren't complicated. They're actually fairly straightforward. If you have any experience in options at all, nothing that I'm going to talk about is probably going to be too foreign. And if you're really experienced in options, what I hope to be able to introduce to you is how easy it is to transfer those same strategies into the currency market as a way to diversify some of your plays. So getting some exposure into the currency market is a great way to kind of just create one more market that is somewhat uncorrelated, perhaps, to other markets that you may be trading options in. And as the title of the presentation said, I'm going to be talking about selling options or writing options. And primarily, I'm going to be focusing on writing options naked. So, which is, there's kind of a, I find that out there in the market, people hear about writing options or naked options and such, and they get a feeling one direction or the other that either, they get a little bit scared off about the quote-unquote unlimited risk, which is theoretically true, but is practically not something that, buying a stock, for example, is technically an unlimited risk. So if you buy a stock, it could fall to zero. Well, the same thing is true here with buying or selling an option. You have a fair amount of risk if the worst case scenario was to play out. But what you have to decide is, well, from a practical standpoint, how does this affect my portfolio? How do I want to address that unlimited risk? The other side of this pendulum that I find is that traders kind of swing to either one, that selling options is way too risky, I would never consider it, to all the way on the other side is, well, heck, there's all these stats from different financial exchanges, like I know there's a famous one from the Chicago Mercantile Exchange that says that amongst futures options, about 80% of them will expire out of the money, which is that's a true statistic, but it can be a little misleading because I find that what traders on that side of the equation look at with selling options is that, well, shoot, I have an 80% probability of walking away with the entire premium. That's a really high probability trade, but like with options, it's always this trade-off. If you go for the higher probability, you're usually giving up potential upside. Buying an option is expensive, but you have theoretically unlimited profits. So you buy a call option and things just really take off, which does happen once in a while. You could stand to gain quite a bit. Whereas when you sell an option, you may have a higher probability of having a winning trade, but you do have a capped gain. That gain is capped at what you received in premium when you initially entered the trade. And I've got several examples that I want to walk through. Before I start, one of the things that I wanted to build a bridge for traders who are a little bit less experienced in options in general, or at least in writing naked options or selling naked options, is that a lot of the things that we look at, so for example, in the equity market, when you look at the risk profile of, let's say, selling a put, so writing a put, versus, let's say, a covered call, the risk profiles are actually very, very similar. When we're selling options on an index like we're going to be looking at today, you don't have the ability to buy the underlying. So unlike a covered call where you'd buy the stock and you'd sell a call against it, we can accomplish some very similar things from a risk profile perspective just by writing a put. And I'll show you exactly what I mean by that. And then as you're paper trading this on your own, you can kind of see how this plays out on an ongoing basis. So I'm going to start out with looking at the Euro USD, and I'm going to go back in time just a little bit. Now, what I tend to do as a when I'm selling options on against a particular index is I'll start to I like to trade with the trend, and now how you identify that trend, I have a couple of ideas for you that I'm going to get to here in a minute. But first I want to talk about the strategies that I might apply, and just go along with me that we would be trading a bullish trend at this point, at this level that you're seeing the charts right now. At the time, we would have been assuming that this was an uptrend. Now, I'll get into a little bit more detail as to how do I look at the trend in the Forex. The other thing that I wanted to clarify here before we get into the strategy is that what I'm looking at right now, the Euro USD, this chart, this is a chart of the actual exchange rate itself. So if you were trading the FX options available on the ICE, you're actually trading options on an index, which in this case I'm going to be looking at the EUU, which as you can see, if you look at the EUU over here on the right-hand side, you'll notice it's currently quoted as of this close at 148.75.99. So 148.75. If we go back to the actual exchange rate chart itself, you'll notice the current price is 148.74. So they're going to look very similar, except that the EUU, the index that the ICE options are based on, is essentially the exchange rate times 100. Now, whether you want to do your analysis on the index chart of EUU, or if you're a Forex trader and you're used to looking at the exchange rate charts, they look virtually identical. Either one, it's fine. It's just a matter of where's the decimal place. So for a matter of convenience, so I have a little bit more historical data, I'm going to be using the chart of the exchange rate itself. But we're going to be flipping back and forth a little bit. Just keep in mind the only difference between what you're looking at right now versus the index that these options are based on is 2 decimal places. So that's the only thing, and that's for pricing convenience, so they can create strike prices, etc. Okay, so let's say, for example, that I were trying to make a decision about a trade here in very early November, which is basically where I've got a paper's edge here on the right-hand side of my chart. And I like this situation here because actually it's not dissimilar from the situation that we're in right now on the Euro USD exchange rate. So as we look at this currency, I'd be running through a very similar process in my mind, and I'll show you what I mean here in just a minute, as to what I would have done back there in the beginning of November, looking at November's expiration options, which are actually coming up for expiration this week. At the time, we're priced at about 147 or so. And in fact, we can take a step back here, and I can even apply a little trend line. As you can see, we've been bouncing up against this trend line for a while. And the market looks like it's about to bounce up again. It's about 147. The question is, well, I may be confident that the market is not going to break support, but how confident am I that it's going to break the prior resistance level? So let's say, for example, right up here at the very top of the market, so we're in this little pullback. We're over here where we're making our decisions. And we've recently been up about as high as 1.5, so $1.5 to the euro, or on the index associated with the option that we'd be looking at here, the ICE options, it'd be 150. So how confident am I that we're going to either hit that resistance level or even break through? So do I want to spend the money that's going to cost to buy a call option? Because that's expensive. Well, maybe not. Let's say that I decided not to, but I'm still bullish. I don't want to buy a put or go long a put or short the currency pair itself. So what might I do? Well, this is a pretty straightforward idea. One of the things that I do is I always go back to look at the previous lows. And in this case, I'm going to draw a little line here down along the prior low, which is at about 145.50. Okay, so we're at 147. The previous low is about 145.50, and I'm just kind of sharing how I would analyze this. What's great about trading is it's completely customizable for your own risk tolerance and how you view it. And I would suggest practice before you take a stab at it in the live market. But you can get a good feel for it just in some paper trading for a couple of months.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.